All India Convention 2022. It is our privilege to have you with us today. I request you to stand up for the prayer, please. Cause of world peace. Thank you, everyone. Now request Sri Sanjay Bansali, Joint Secretary, to administer the pledge.
Happy morning, everybody. I'll request everyone to kindly raise for the pledge of our FIPA. Kindly repeat after me. We, the members of Federation of Indian Hire Purchase Association and members of its affiliate associations, we pledge that we shall do business in a fair and ethical manner, maintain high levels of honesty, integrity, and transparency, serve our customers with dignity, respect, and a deep sense of pride and purpose. We pledge to continue delivering last mile credit to make financial inclusion a reality and accord higher standards of service to our customers. We pledge to create self-employment opportunities for the unfunded citizens and help them earn a livelihood and thereby make a reasonable earning and profit. We pledge to act responsibly and generously with every customer, even in their times of distress. Always work towards educating customers and finding a fair solution to our customers' difficulties. We pledge to abide by the laws of our country and follow fair business practices of the industry. We pledge to always work towards growth of our customers and bring light to their lives, thereby finding the path of our growth. We pledge to make our nation proud through every transaction executed by us and contribute to the growth of our nation and fellow countrymen. Thank you so much.
Thank you, Sanjay ji. I now request President Mahavira ji Lunawat, Secretary General Dinesh ji Kothari, Treasurer Om Prakash ji Agarwal, past Chairman Shri VJK Prasad ji, Shri Kailash Mal ji Dugad, Convention Chairman Rajesh ji Bhurat, and FCA Co-Chairman Madan Lal ji Gundecha to light the Kuttuvilat. Thank you. I now request the Convention Chairman Rajesh ji Bhurat to speak about the convention.
Namaskar, respected dignitaries and all the delegates present here and watching online. I, Rajesh Bhurat, Convention Chairman, welcome you all to the All India NBFC Convention. Today convention compromises of mind-blowing subject with interactive session taken by industry experts and leaders. Regulatory aspect and legal compliances are very important and have to be compliant with. Therefore, we have to also design in a in-depth filing session. The convention will also provide the members an opportunity to interact with business leaders and industry peers. The theme of convention says, till today we have challenges. Today we will find solution here, and from tomorrow onwards, growth, growth and only growth. This is the theme. इसलिए अपने आप को, अपने हौसलों को ये मत बताओ कि परेशानी कितनी है, बल्कि अपनी परेशानी को ये बताओ कि हमारा हौसला कितना बुलंद है, कितना बड़ा है. धन्यवाद.
Thank you, Rajesh ji. Now call upon Chairman Mahavira ji Lunawat to give the welcome.
Happy morning, respected dignitaries, all the delegates members, and those who are watching also, our office bearers. I welcome you on behalf of our FIPA. Friends, after a long time of COVID affairs, we could not able to hold this convention. Today this opportunity has come now to educate our members about the NBFC's new role by this RBI's affairs is also coming long way. This is the opportunity we got to learn about the regulation and other activities to our members. Friends, we have tried our best. Since previous also there was a RBI regulation was that from 2 crores to 20 crores. We have fought like anything with them. Finally, from 20 crores now RBI has come down to 10 crores. For that also, we are still trying to see that it comes as old 2 crores. Friends, Federation is doing our best to make them satisfy our all members. So again, I thank you very much for participation in this NBFC's convention. Thank you very much.
Thank you, sir. As you can see, we are also live on Zoom. We have participants from all over India. So without further ado, let us start with our business sessions. We are fortunate enough to have prominent industry professionals speaking to us today on topics pertaining to the NBFC industry. Let us hear their experience and views on the subject. I would now like to introduce the panel for our first business session of the day. Mr. R. Anand. Mr. R. Anand is a qualified chartered accountant. He has worked for over 20 years in Sundaram Finance Limited in various positions. His last position in Sundaram Finance was Vice President of Corporate Affairs. Thereafter, he was a partner in Ernst & Young. He holds a directorship in various companies, 5-Star Housing Finance Limited, 5-Star Business Finance Limited, Nani Palkhiwala Arbitration Center, and the Chennai International Center. He was a past chairman of the Indo-American Chamber of Commerce, SIPA, convener of study group on guidance note of audit of insurance companies, member of research committee of ICAI, chairman taxation committee, Madras Chamber of Commerce and Industry, member of CBDT committee on accounting standards, member of Nidhi Companies Committee set up by the Department of Company Affairs, Committee for Revival of MSMEs in Tamil Nadu, which has recently submitted its report. We have with us Sri VGK Prasad ji, Managing Director of IKF Finance Limited and IKF Home Finance. He is also the past chairman of the Federation. He has over 4 decades of experience in the vehicle finance business. We also have with us on the panel Mr. Deepak Dugar. He is the joint MD of Mahavira Finance Limited, a Chennai-based NBFC. He's a BCom by qualification and he's a joint managing director of Mahavira Finance Limited. I now hand over the proceedings to Sri R. Anand, moderator for the session. Thank you. Yes, I request you to please join us on the dais.
President and other office bearers of the Federation of Indian Hire Purchase Association, various delegates who have assembled here in large numbers, my colleague panelists, Mr. VGK Prasad, Mr. Deepak Dugar, and my other friends. In fact, as very appropriately mentioned, It is good to meet all of you post the pandemic. And in fact, I was jokingly mentioning to somebody that with a vengeance now we are meeting now more frequently. There was a very big seminar of the Madras Hire Purchase Association organized just about a month back, and the hall was packed, 300 people, and now we have about 150 people. And many more watching on Zoom. So which clearly demonstrates two things. One, people are very hungry to come back, meet everybody and sort of exchange notes. The other important aspect for which we have to feel very happy about is that business is also looking up, and therefore people are all encouraged to come and then see where else they can move the needle up and ensure that the growth agenda gets translated into concrete action. Now, I don't know whether it was by design or otherwise, the first subject itself is a subject which will kickstart the entire probably deliberations for the day. It is about growth through funding. And the catchword is equity versus debt. And if you drill it down further, it is about various other components of debt, various other components of equity, which is so important now for us to bolster our liability side of the balance sheet, which will enable the asset side to naturally grow because of the importance given to the liability side. Before I ask the panelists to come in and chip in with their experience and loads of experience which are there, I just want to make a couple of very preliminary remarks considering what has been the evolution of the liability side management of NBFCs over a period of about 30-35 years. In the good old days, and all of you know, we all like to start with good old days to reaffirm how old we are today. That is one reason why we want to say good old days. But more importantly, I remember in 1980s and 90s, we were looking at only two aspects on the balance sheet, equity and public deposits, and some parts of bank borrowing. Now, public deposits is virtually out of the window, except 2-3 large companies. Very few companies are accessing retail public deposits. So the whole architecture of your liability side has undergone a sea change over a period of 30 years. Now it's all about the right kind of equity, right kind of debt. How do you manage equity and debt? It's not equity or debt, it's about equity and debt. How to leverage your equity 6 times, 7 times as is required, and how to get the best return on the funds employed. See, finally every business is about the number which stands after you translate all your business into reality. After you collect the last installment, what is the return that you have got on each contract? What is the return that you got on your funds employed, on your equity employed? That is the test of the success of any company. Whether it's a small company, medium company, large company, it doesn't matter. You are putting in money, you are not in charitable business, you are in commercial activity. You are in the business of borrowing money, lending money, generating a return for your stakeholders. So whether it's equity or debt or equity and debt, the most important number that all of us have to track is return on equity and return on funds employed. You keep that metric in your mind and test that metric on a periodic basis, annual basis, every 2 years, 3 years, and satisfy yourself that you are doing the right thing by getting the right return on equity and your funds employed in your business. Having said that, if you have noticed in the pledge, we are not here to make usurious profits. We are here to make commercial profits, but not usurious profits. And that is why we are responsible financiers who have to manage our equity and debt in such a manner that our balance sheet looks clean, our balance sheet looks understandable, and our balance sheet is attractive from a fundraising standpoint. Now, I don't want to jump in and say which is better or what is the right mix. It depends on business to business. It depends on your class of assets on the asset side of your balance sheet. Whether in two-wheeler, a different type of mix will help. Commercial vehicle, different types of mix will help. Used commercial vehicle, used LCV, different types of mix will help. It all depends on what is your target, and based on the target, what is the right type of liability mix that you have on your balance sheet. So these are some of the preliminary thoughts, but as we take the discussion along, I am sure a lot of interesting insights will be brought in by both the speakers, and I'll try to chip in as the need arises. So without much ado, may I now request first Mr. VGK Prasad, a veteran in this field, who has seen this game again for the past 30-35 years. And he has successfully scaled up his balance sheet from a very, very starting point level to the level that he has reached now. I don't want to tell that number. He has to tell his balance sheet number. And how he very effectively used equity at the right time, at the right price, and for the right deployment. That is the journey of the equity that he demonstrated in his balance sheet. It will be interesting to hear his story and how equity is also important now for the next phase of growth as far as any journey of development is concerned. So may I now first ask VGK Prasad to start his story, and then we'll move on to the next speaker. Mr. Prasad, please.
President of Federation of Indian Hire Purchase Associations, Sri Meghnad Ji Lunawat, Secretary General Sri Dinesh Kothari Ji, my learned friend, Convention Chairman Sri Rajesh Bharat, and Mr. Anand, veteran of the chartered accountant and a veteran in this field, though he may not be directly involved in the business, advising all of us, and Mr. Deepak Dogar, the co-panelists, and my brother financier sitting before me. Thanks for inviting me and giving me this opportunity to address you. More than addressing, I am happy to have met so many friends whom I have missed for a long time. 2-3 years, most of them, and some friends who I have not met in 5-10 years. And thanks for giving me this opportunity. So the subject given to me is about equity. And so it is like a capital. Any organization, if you want to do business, you have to raise capital. So effectively, we can say in the initial stages, that is equity. We need to raise equity. But regulator in his wisdom has thought that NBFCs should be given a leverage to borrow debts based on their equity, so that they can serve the society in large, which is the interest of the government and the regulator, and also in the process to make some money. NBFCs to survive cannot survive only on equity, they need to leverage the equity. So again, as you go along in the business, the initial capital that you invest will get added on by the profits that you generate, and then minus whatever dividend you have paid. Nowadays, a lot of companies are not paying dividend, are paying very less. That adds to the balance sheet, and that becomes the net worth. So now the equity can be considered as a net worth. Going forward, instead of equity, I will talk about the net worth. And I will talk with particular reference to NBFCs, because the convention itself is called an NBFC convention, and most of our partnerships have converted or are in the process of converting into NBFCs, which seems to be the intention of the regulator as well as the government. So now regulator has said the capital to risk assets ratio of 15% for NBFCs. Effectively, that translates into you can leverage your equity by 6 times. That is permitted. The maximum leverage could go up to 6 times. And your capital to risk assets ratio, Mr. Anand will explain in detail if you have any doubt how it is calculated, but it should not be more than 6 times, which effectively converts into 15% ratio. Having said that, is it possible for our NBFCs to leverage that much that much? I haven't seen any company, or maybe very few exceptions, maybe some housing companies, where we were able to leverage by 6 times. The reason is this. We say, for example, we raise 10 crores. We borrow, say, 40 crores. The bank says 25% is your margin. So to borrow 40 crores, you have to invest 10 crores. So your entire money is there invested. Now he says you have to keep paying on time whether you receive or not. And then all our customers will not be paying on time. You need some cushion for that. And then some banks say you can give only regular assets as security. Sometimes they take primary security, they may secondary security. So even one EMI due, that becomes, it cannot be given as security. Effectively, what I have found is 40% margin is what we require, at least for some NBFCs. As you go forward, as you get ratings and grow up, maybe you can leverage better. But still now, for our companies, I find that 40% is the leverage that can happen for us. And then regulator in its wisdom also has permitted Tier 2 capital, which can be considered as a quasi-capital, where we can leverage that to raise funds. So effectively, we can say regulator himself also has permitted 4 times, and we also at best can leverage up to 4 times. I have been in talks with various banks, and they say, what is your leverage on AUM? Not on your book size. I say 4 times. 4 times is okay. And then the rating agencies, how much are you leveraged? Once you cross 4 times, then the challenge comes. The rating agency feels you don't have enough cushion by way of capital or net worth to take care of stress times, like in COVID, some other times when the economy is slowed down. So effectively, we need to keep raising capital. Maybe we can say that if you want to go into a 100 crore company, at least you need to have somewhere around 30, 35 for a companies of our size. I am not talking about very big companies where banks themselves say 10% margin is enough, or certain other concessions are given. But in our case, this is what is required. And then capital, my suggestion is we have to keep on increasing the net worth. We are riding a tiger. You cannot get down from the tiger, it will eat away. So as long as you are in the business, you have to keep riding it. How do you ride? I can also put it in a milder way. You are on a bicycle or a two-wheeler. So you have to keep driving. You cannot say, I will go back or I will be stagnant. No, it will not, your company will not be able to do that. So you have to keep growing. You have to keep doing business. The only way that you can stop business is selling your company to some other NBFC or some other bank which is willing to absorb it. Otherwise, you cannot do that. And then rating is also ask you, what is your growth? I will give you from my example. Our growth was 27% over last 5 years. Rating agencies with certain, with certain amount of reservation said, okay, we are okay because your quality is good. Then private equity investors who have invested, you are extremely low. You are not up to the mark. Mr. Prasad, this is not what I expected from you when we invested in you. So there are other peers who are doing much better. So they say 40 to 50% is what is required. I will come to that later. So what I am trying to suggest is, you have to, if you want to grow, which is compulsory, you need to add money to your net worth. One way can be that you don't give dividends, but you add it to your profit and balance sheet so that your net worth keeps going, whereby you can leverage on the added net worth also. That way is one way of growing, but that may not be enough. You have to keep on adding. So how do we raise fresh capital again? Are we able to? So there are various means. One is that, as I said earlier, regulator has permitted Tier 2, which again, rating agencies will not consider it as a capital. Only for the sake of regulation it will help us, because again it has to be more than 5 years, it has to be unsecured, and then as year after year it goes down, then that cushion also will be lost, and then this will have to be again like a riding a tire, you have to add more and more Tier 2 capital. That is, anyway, having said that, a certain portion of Tier 2 can help you in meeting the requirements of the regulator. Then other than this, you can take more partners, or you can add more capital of your own. But here we have to find, I have a lot of friends. My business I have learned from a lot of your seniors. I came from an agricultural family. I wanted to start an industry, but my finance business was doing good. So we entered finance business. So we have gone through a lot of cycles. That's a different matter altogether. But when I visited these conventions, I learned a lot of this, my experience from our people. We can learn from Sundaram, Sriram. They are all very big people. This knowledge that we earn is not applicable to what we have learned from them. These are all completely different things. But why did you not grow? Why we were able to go a little? Now, I don't say that we are going extremely well, but some growth is there. Why? Because I have found two reasons. One is you are satisfied. I am getting my money. I am doing well. Okay. And then second is you focus on NBFC business, but again you invest on one, two, three different businesses. So what is happening is that your NBFC or your finance business is starved of capital. Once the capital is not growing, your net worth is not growing, banks will not be comfortable giving loans to you. Mr. Dogar knows it, Mr. Deepak knows it, Mr. Anand as a chartered accountant, a lot of you would also be knowing. But now we will have to decide whether the focus will be this. Some diversion can happen, but that's a different. But our focus should be this NBFC, growth of this NBFC, and for growth of this NBFC, we have to keep on investing money. We have to keep on equiting net worth. And if your business does not grow, beyond a certain point, you will not get a rating. If you don't get a rating, olden days where you are very good, your quality, those things will not work. Rating is mandatory for anybody to look at you. Even NBFC's funding also, they ask you, what is your rating? So is it BBB plus, A? That question comes. So to get that rating, we have to keep on adding. It's not enough you make return on assets, return on equity, NPS, and these things will not be enough. You have to keep growing. So to keep growing, again your capital is required. So when you increase your capital, you grow. When you grow, you grow by getting more loans, by leveraging your capital, and then as you grow, your rating comes. I am told with talking discussion with a rating agency, any customer below 100 crores, we will not be comfortable giving rating, even if he is doing extremely well. So rating, so this is going to be a major challenge for a lot of us. If you want to convert into an NBFC, then you should look at immediately from the first 2 or 3 years, it may not be enough. You have to keep growing. You have to keep adding to your capital. Otherwise, rating will not come. Rating is the most important factor in raising debt. I am trespassing into an area because this is what I am saying with reference to equity. I will not try to, I know my red line. I will not cross that. This is something related to capital, equity. That is why I am trespassing there. Please pardon me. And then there is another method by which the capital can be raised. Even that happens when you cross 100 crores only. There are some PE funds who are willing to invest. Bigger funds invest in bigger companies. There are some PE funds who invest in NBFCs. They say they find the right promoters, they find the right business, and then they invest at the initial stages. They may not come at a very high valuation or your multiples of your book value, but they come, they guide you. There is a lot of contribution they can also make. Sometimes they say there is a pain in the neck also. No, there is always pressure. That pain in the neck is like, when your father beats you or when father admonishes you when you don't study. There is something that they are all driving. There is also something that we can look at. So, as I said earlier, try for reach for 100 crores, maintain your quality. Olden days where your return on assets or your profitability, those things are not very relevant. We have gone to a PE fund. I will quote from my experience. Our return on assets, return on equity, our quality of customers is considered to be extremely good for the industry. But we are not getting the valuation that our peers are getting because we have not grown at 40%. I said we have slowed down in COVID period. Post demonetization, when the heavy commercial vehicle segment was taking a hit, we slowed down there. We moved on to the small and LCV segment, where the transportation is of essential commodities. which are not impacted as much as heavy commercial vehicles because of the COVID. We made there in the process. We did a lot of explaining, but they were not willing to listen. Mr. X has gone by 40%. Mr. Y has grown by 50%. All other things are immaterial for us. Mr. Dugar knows. So these are the challenges we get. So focus has to be on growth. Your growth at a reasonable pace. But again, it's not enough if you grow and your NPS increase, then again it's a challenge. If your NPS increase, your profitability is less, your return on, so there again there's going to be a challenge. So focus will be growth. At the same time, along with growth, we have to maintain the other aspects also in control. So basically, these are the things that came to my mind. It is a very limited subject. And then debt, there is a wide area that can be looked at. Mr. Deepak, my young friend, will enlighten you on it. Thank you, sir.
Thank you, Mr. Prasad, and I think you have set the ball rolling correctly. And as you would have noticed, there are two very important points he has made. One is riding the tiger. Once you get into equity, you can't get out of equity. Whether it's private equity, your own equity, once you put money in a company, you have to make a success out of it. You have to keep growing, also ensure that there is enough return on the investment. Both are very important. The second part is that today we are living in a situation that we are accountable now to everybody in terms of how you are raising money and how you are deploying money. It was not only about a relationship between you and your customers. Credit rating agencies, regulators, society at large are also looking at you very closely. And information is now spreading so fast, WhatsApp, technology, otherwise. So the moment you publish your results or on the verge of publishing your results, every regulator or every rating agency or every analyst picks up your peer's performance and they say, he has done like this, you could have done better. This part of geography, he has done better than you, you are not doing better than him. So this comparison now is becoming a very infectious type of a disease. So we need to benchmark ourselves and ensure that when we grow systematically, properly, ensuring the right deployment of funds, whether it's debt or equity. The jury is not out yet as to which is important, debt or equity or both. We will do that after the culmination of the session itself. So Mr. Prasad has explained his experience about equity and how he is masterminding the success of an equity structure in his company. Deepak Dugar has, as a youngster now, second generation company, he has ensured that they have started in a particular way, traveled a journey which is very, very learning curve for them. And today he has raised equity and he has also managed debt very carefully, very systematically around the equity base. So it will be interesting to hear his story about managing debt via equity.
Good morning to everyone. So, first of all, it's an honor standing here and addressing everyone. I think I have learned all my life from all of you, and it's a great feeling to stand here and talk about a subject. And I'd like to thank the association for giving me an opportunity. Thank you so much for this first. So, as rightly said, debt versus equity. Well, I think Mr. Prasad has clearly said it's not debt versus equity, it is debt and equity, which is the right way to go forward. I'm not a veteran in this, but I would like to just give a few technical details about debt, and then I would like to share more on the practical experience of how we have taken it forward. I guess technical, Mr. Anand, Mr. Prasad, and all of you are all veterans here, so I guess I will leave it to all of you all, and if you have any queries on technical as well, they will answer better than me. But on the practical front, the last 5-6 years of our journey is what I would like to share. Maybe it helps all of you. So I'll just start with the technical front first. Thanks. Yeah. So what is debt? Debt is money borrowed by one party from another and repaid with interest. So, and agreed period and frequency. Yeah. In other words, it's called a debt capital used for business expansion and paid over a period of time. Debt is also available in various kinds of instruments, and each instrument comes with a different cost and a structure. So these are the various kind of debts. Well, I have, as much as I remember, I have presented. There are sub-debt, there is term loan, there is an NCD, there's an ECB, there's a cash credit overdraft limit, there is a refinance, securitization, co-lending, partnership, bonds. Of course, co-lending and partnership is not actually part of debt. It's a little different, but I just added so that I thought it will be of help. So, what are the different types of debt financing loans? Well, there are three kinds of debt financing loans. One is a fixed term loan. These loans have set repayment terms and monthly payments. The loan amount is received as a lump sum payment upfront, and these loans can be secured or unsecured. And then typical examples are term loans where you are paying monthly EMIs. And of course, you have these bullet payments as well, which are commercial papers, NCD, ECB, bonds. Then we have something called revolving loans. Revolving loans provides access to an ongoing line of credit that a borrower can use to either repay or repeat or grow his business. So the typical example, I think, which all of us as an NBFC understand is cash credit limit, CC limit from banks, overdraft limits. So the last one is the cash flow loans. So cash flow loans are basically a lump sum payment from the lender, which is used, it is basically more a buyout, and the whole profit is used for us, and it is not part of the balance sheet as well. So that's the typical cash flow loans, which is refinance. You have securitization. In securitization, you have something called PTC, pass-through certificate. We have something called direct assignment. So technically, I guess, I'm sure Mr. Anand and others can explain it more in detail on that. So again, debt financing can be into two parts. One is short-term and one is long-term. So short-term debt finance gives you access to quick loans for a short duration, and it's basically used more for a temporary financial emergency, is what we understand. And typically, when you want a short loan in an emergency, the interest rates are a little higher compared to a regular loan. Long-term debt financing. These are typically loans which are taken for more than 2 years plus, is what we assume. And long-term loans carry comparatively a lower rate of interest over the course of the loan tenure. But you have a commitment of an interest, which is an obligation for longer period, which can be a variable factor. So, advantages of taking debt. I mean, this is I think the most talked about topic right now. So, it's just, one of the biggest advantages is leverage, as Mr. Prasad has already told and Mr. Anand has already informed. So, leveraging is very important. So, once you're able to take debt, you're able to leverage your business and your capital, and that helps you to create growth and to grow. So that's very important to leverage. And the leverage ratios are very different today. Some people say 4:1, some say 5:1, some say CRAR. I mean, there are different variants in that, and we can have some direct assignments, which can be off balance sheet. We can do some co-lending. So you can grow even 6 to 7 times of your book, of your capital and your NOF. So again, one of the advantages of taking debts are retain ownership of the company. Majorly, the major advantage of taking debt is it is stake free, which means the ownership stays with you. And tax advantage, I think the interest payable by the company on the loan is deducted from the company's tax returns. So this reduces the overall tax liability and cost of debt for the finance. This is another big advantage. Of course, the third, easy financial planning. Since the rate of interest is fixed and the exact, you know how much interest is to be paid month on month and your EMI to be paid on month. So you can plan your cash flow much better and engage in efficient planning and budgeting, which helps us to, maintain our credit score. So I think one more important point is it is really faster, and you have many options available today for companies to get debts. There are different kinds of debts available in the market. There's not major disadvantages, but I think one of few of them is, it's a compulsory repayment month on month, whether the customer pays or not. So we have to have that liquidity buffer in place. Then if the company goes bankrupt, then the lenders have to be paid first before the equity shareholders. That's one. And collaterals, of course, every lender expects a collateral. It can be, your company collateral or your personal collateral as well. So that's one thing which is very required and taking a debt. And then the last point, I think one of the most important points as well, as Mr. Prasad also said, is credit rating. Now today, credit rating is taking a big place with CIBIL and everything coming up, and even banks are asking for ratings, CRISIL, ICRA, everything. So when you take a large debt financing, it can affect your credit rating. So by chance, if you are delayed in making the payment, it spoils your reputation, and too much exposure also gives you an effect on the credit rating. So I think this is the discussion today, debt versus equity, and I say debt and equity. So I just put it somewhere that too much of debt, it is over leveraged, and too much equity is under leveraged. So I guess the decision is a trade-off between risk and return. A firm should adopt a policy that minimizes risk and maximizes return. This is what we feel. Yeah, so that's it, I guess. I just wanted, so these are the technical fronts which I could explain a bit. And I'm again clear that I'm not an expert. I may have missed out a few things. And I'm sure Mr. Anand and Mr. Prasad and others can help on that. So now I would just like to share a few practical experiences of how Mahavira Finance. So basically, just a quick introduction. Mahavira Finance is a company which was incorporated in the year 1981. And my dad, the managing director, Mr. Mahavir Chandugar, took over this company in 1987. And with a 10 lakhs capital is what we started. So we have gone through all different phases, and the first thing, as Mr. Anand rightly said, was public deposits. Those days it was a small equity, and the other way of getting money was public deposits. So we had a huge public deposits we had taken in those days, and then there was a new government regulation with all the Ramesh cars and all coming in. So we had to refund deposits, and that was a very big phase wherein you borrowed the money, there was a major asset liability mismatch, and we had to refund the money. So we grew the business, we had to bring down the business again. Then came the next era of, I think, securitization. So there was no limitations on securitization. You could just keep doing your business and growing your books. So that is how we started in Mahavir, and thanks to companies like Sundaram and Shriram and a lot of companies who supported us in the 2000s, and we grow our book. We were able to do close to 800 crores of business on securitization. But again, the government came up with certain rules, and due to the seasoning and all that. So again, we couldn't grow it to another level. Then we started getting into the franchisee model, wherein we tied up with Shriram Transport and grew our business as well. This was around 2010, 12. So we all started growing our business and grew. So finally, I think we have gone through almost 3 to 4 cycles from 1987 to close to 2014, 15. One thing we realized is the most important thing is your leveraging. Second, the most important thing we felt is probably, you know, have a mix of debts. So that's when we understood. I mean, Dad came and told me and my brother also is part of this business, and he told us that, okay, now what's your plan? So as Mr. Anand rightly said, we had a lot of his other businesses as well. Mahavira Finance was one. I had some personal businesses which I used to run, my brother used to run. So Dad told me, okay, what do you want to do? Do you want to grow Mahavir, or do you want to just keep it like that, as it is, just the limited? So the idea was either you look for profits or you look at creating wealth. These are the two things which we had to take a call on. So we decided, okay, Dad said that you have to close down all your businesses and take equity, because we were getting some equity interest that time, people were ready to invest. So that's how the equity journey started. And it was very clear when we took the equity, as Mr. Prasad rightly said, we are sitting on a tiger. So we have to keep running. Till then we were not sitting. So once we sit on the tiger, then the only way is keep growing. So that's how we took the plan. And with all our experiences of debts, we really understood that we should never depend on one kind of a debt. Have your varied debts available in the market. Take some NCD, take some ECB, take some term loans, take some securitization, and start growing your book. And we are proud that in 2016, before the equity came in, we were at a 40 crore book, and in the last 6 years, and today in December, we have closed 400 crores plus book. So we've grown close to 10 times, and it's been totally because of equity and because of debt. So we have a NOF of close to 80 plus crores, and we have leveraged almost 5 times. So I just wanted to share my experience that we always tell everybody that we are a 5-year-old startup company with 35 years of experience, because we started only in 2016 to grow our books, although we have 40 years of experience. So I think debt and equity is very important. And can you just see the last slide, please? Yeah. So the biggest learning is diversify debt, both in terms of providers and products. I think this is something which I have learned. And I thought I should share this. I think my experience is this totally. And thank you so much for giving an opportunity. Thank you so much.
My memories went back to, again, 1990s, when we as youngsters were making presentations. This is a new generation of people coming and confidently making presentations about their stories without any inhibition. That is what is required, because we live in an atmosphere where this type of success has to be infectious. Success has to translate into more success. And the jury is clearly out. See, in this business, I remember we used to analyze the best balance sheets of India again in a few years back. Colgate India was the best because zero debt for years. Best performing company, Colgate India, because every day everybody has to have toothpaste. There's no sort of a recession in that business at all, but zero debt. But in this business, we cannot be like that. It has to be equity plus the right type and component of debt. And as Deepak Duhar very rightly put out, look at the range of products now available. The product range is also large. The provider of finance range is also quite large. You have so many banks, so many large banks, medium-sized banks, small finance banks, and so many quasi-banks also coming in to provide debt. Only the pricing is an issue that you have to sort out. Another important point is, and made by both the speakers, see, this leveraging is a very difficult concept, at least to understand as an accountant, understand as a businessman. We used to call it debt equity, now we are calling it leveraging. See, at 6 times, you are very highly leveraged, but at 6 times, you will get the balance sheet which will be most acceptable to all agencies. If you are 3 times leveraged, some investor will tell you, look, Mr. Prasad, you are 3 times fine. Had you been 6 times leveraged, Your AUM would have gone up from 3,000 crores to 4,500 crore, and at that AUM you would have got 0.5% less from bank borrowing, and your return on investments would have been much better. So there is always something which is always better than what you have achieved on the balance sheet. That is the uniqueness of our business. Whatever you do, somebody will say, this element could have been done better, whether it's debt component or equity component or a combination of both. But the message which is loud and clear is that as years go forward, we need to have a lot of equity strength on our balance sheet, the right proportion of debt, with a clear understanding of where the money is going to, which product, which market, which geography, which vehicle, and generate the right type of return. Because the last thing that we want to do to all stakeholders is to be a defaulter. That's the worst thing that can happen. None of us want to be a defaulter to anybody, whether to equity investors, debt investors, or anybody else. So that is the success of our industry. We have never been defaulters. At best, we have faltered here and there on compliance, this, that, that's okay, fine. But we should never be called a defaulter, whether to whom, from whomever we have borrowed. We have about 20 minutes. What I propose to do is, another 5-10 minutes, I want to ask quick couple of questions, both to Prasad and Deepak Dugar, and then we'll throw open to question and answer. And Mr. Prasad, see, in your journey, as you rightly pointed out, you have used equity now, excellent, and then you have protected a balance sheet which is now very sound for the next phase of growth. According to you, in the next 5 years horizon, how do you look at various products on your balance sheet? Will it be the same, very prescriptive, or you would like to have more range of products on your balance sheet for the next phase of growth as far as your company is concerned? You can.
Thanks, Mr. Anand. This is a very difficult question. You can keep on increasing the products. Again, then you are not backed by the decades of experience when you go into a new products. But within the range of the products, there is always a possibility for diversion. And then your policies should always be dynamic. Within these products, if something is not doing well, you should not say, my father has done this business with these products, I have done for decades, and I will be stuck with this. That should not be the way we do business. Based on conditions change. The only constant in the present economy is change. We also should be prepared for change. So coming to ourselves, say, I will quote from a private equity investors. When they came to us, we had 90% vehicle book, or 85 to 90, between 90, and 10 to 15% SME book. This SME book had become a hindrance for us in raising funds, because they said, you have too many products, your experience in SME is less, whereas in your vehicles, it is a long experience. Why did you divert? I said, it is for the sake of risk diversification. But again, you are increasing your risk. These are the challenges. You can be comfortable. You also have to be mindful of the other players who are going to support you. That is one challenge that is going to be there. And then in raising debt also, these challenges can come up. Coming to us, we will be focused on the vehicle segment. Plus, what we thought was internally, SME is a good product. Actually, our SME was doing extremely fine, and it was giving us good returns, but still the investors did not get satisfied. So that became a hindrance for us in raising funds, which brought down our valuation. It is not enough if you think that this is doing good, I am going at the olden days are not. So your bankers have to support, your rating agencies, they had a lot of discomfort. Why are you moving into SME business? Some companies have failed, we know aware of that. It doesn't mean, even vehicle finance companies have failed, it doesn't mean that we are going to fail. You are prudent, your policies are there, and then you have put your filters properly, but they don't agree on that. So there we will have to convince them. And internally, some diversification for the sake of risk distribution, it can be done. That's what we propose to do.
Thank you, sir. That was very useful. Now, Deepak, I want to ask you this question. You are a youngster and you embrace technology very easily now. In managing your debt, I see two challenges in bringing in technology in managing debt. One is, of course, the MIS system itself, The other is there are a lot of covenants now in debt obligations which are in the agreements. Now, how do you see some of the dangers in the covenants, in bank agreements? How do you ensure that as an organization, you are protecting your company from all the risks with those covenants, and how do you use technology to arrest those risks?
Sure. So, yeah, I mean, it's a very valid point. It's a real challenge nowadays with the governance, especially, a lot of rules changing every 6 months. RBI is coming out with new policies and different. So we have to have a team in place. We have company secretaries, we have internal audits, and so that's the only way we'll have to create it and keep growing and keep controlling. I think the most important thing, as you rightly said, is MIS. So today, I think if you want to do a business, the two most important things is, one is people and second is process. If you have these two right, and now I think the third buzzword is technology. So people, process and technology, these are the three things which are very, very vital. And the way the market is moving up, I think everything can be controlled on a dashboard, on a single platform, and we have teams in place. And if you're able to create the proper teams to manage it, and you have your governance in place, controlling the governance with a proper team, I think it's totally possible.
Very, very nicely summed up, because compliance, governance has got a cost, and you have to factor that cost in your workings. In your net interest margin, that's the most important element. Apart from manpower cost, compliance and governance cost has to be factored in when you do your pricing. And in your all products, on the liability side, that element also has to somewhere subconsciously work in your system, that there is a cost to manage these particular products. We have about 10 or 12 minutes for Q&A, so I would request any of you, I'm sure there is some arrangement of mic going around to enable you to raise the question. Only to Mr. Prasad and Deepak and not to me. Somebody said I am supposed to answer. I am not supposed to answer. I am supposed to only raise questions. Anyway. Please announce your name and your organization, and then you can ask the question. You can just take the mic around too.
Said we should not be defaulter. We should not be defaulter to anybody, equity or debt. But whether we accept or not, some financier sometime defaulted, and it hurt reputation of all financiers. So what is the main reason, or what we should take care that in future at least financiers do not default? What went wrong?
Correct. Good. How do you arrest default? Prasad, you would like to take that? We should not be a defaulter, I agree. But what are the steps to be taken to ensure that that doesn't happen is very important. Preventive steps.
So, we should be conscious that we are playing with public money. The first step is that when you are lending, you have that in your back of your mind, this entire money is not yours, your responsibilities are there, so you have to be mindful of that. So there can be a lot of hiccups that can happen. There also you need to be efficiently insulated. But fortunately for us, if you see across the history of NBFCs, bigger NBFCs have failed, but smaller NBFCs have never failed. There may be a delay in payment. It is again related to the strategies, the arrogance, the diversion of funds. Those things will not be there. I'll give you a typical example. When the first wave, COVID wave was declared, lockdown was declared, RBI said, NBFCs can give time to all the customers. But the message that went into the market was it is a prerogative of the borrower to exercise that right. So nobody paid. So what do? We can't fight with everybody. So automatically we gave them. But how many people have we borrowed from? There were 22 institutions that we have borrowed at that time. Except Sundaram Finance. Not one has given time. Even Sundaram Finance we have not asked. Within 1 week, I received a letter from Sundaram Finance. If you require, you can use the moratorium of 6 months. So anyway, to be cautious, I utilize it. But Sundaram Finance is only a small amount of our exposure. So we have to keep paying. So we also have to be prepared for that. After 2 months, then the government and the became wise. They say they came out with TLTRO, then they came out with PCG, lot of things. They supported us. But these 2 or 3 months were very crucial. You cannot default. If you had defaulted, we have a history of decades. 30, 40 years, we have never paid a single loan interest even 1 day late. If it was a holiday, we paid 1 day in advance, not late. That is our reputation. There are no godfathers for us. It's our reputation that has to build up. So we have to be mindful of our risk. We also have to be prepared for the risk. And some cushion should always be there so that you are very careful about it.
In fact, as best practices, some NBFCs follow this principle of T minus 2. T minus 2 means if the due date to payment is 30th, you have to pay it by 28th. Not on T, but T minus 2. Allowing for some bund, disruption, this, that. So that gets ingrained as a discipline in the internal system of the organization. Any other question, please?
You said about the concentrating on a single product. That will give you the more credit rating. During these COVID days, people with different products, they were able to manage the cash flow. How do you manage the cash flow at that time?
Cash flow in COVID times, correct?
You have a single product. When we have many products, in one way or other, the cash will come in or go out.
We need to say, so your question has 2 different aspects. One, should we distribute to various products, or within these products, how do we manage the cash flow? We always need to be prepared for the bad times. Some cushion should always be there to take care of it. Economy can be booming, economy can be slowing down. We need to have some cushion always in the back to manage the cash flows. In fact, when the COVID was declared, we had 150 crores of bank balance. This is what we maintain. As a policy, we feel that 3 months disbursement and commitments should always be maintained in the form of cushion. Nowadays, CC is not coming. We have, fortunately for us, being a old generation financier, we have got around 300 crores of cushion. So there is no cost to the maintenance of the funds. This also. That is how we have managed.
This is a good formula. 3 months disbursements, park it separately as a cushion. For some calamity, some rainy day, you can draw it when you want, instead of going and running behind a banker who will not give you at that time. Any youngster to ask a question to a youngster? Less than 40 age is my definition of a youngster.
Yes, good morning, everyone. I am running a small proprietorship concern. So I wanted to ask what will be the right kind of debt I can avail now, and how can I just move forward regarding this? How can I obtain a debt? What are all the options available for me?
We need to understand your capital and your business, and then there are a lot of options these days available in the market. Basically, you have institutions like Northern Arc, Vivriti Capital, who are helping you to borrow money. They allow you to connect you to NBFCs or banks. Of course, if you are having a bank connect with your own existing, if you are having a savings bank account, you can go and check with the bank. Or you can, if you have already a cash credit limit, you can check with the bank. So there are various parameters, and probably you'll require some guidance, maybe have a consultant and ask him to understand your book, understand what you want, and then make a plan and then work towards it. And we are there to help you for sure. If anything help required, you can always call me. I'll help you on, connect you with Northern Arc or Vivriti Capital is what we know. Thanks.
Please, please.
You said you are a sole proprietor. Am I right? So first of all, as a sole proprietor, he has no options to borrow. Section 45 as sword is hanging. You cannot borrow beyond your 12 relatives. So as Deepak said, you can think of some co-lending or doing some franchisee work. For proprietors, please try to understand.
Can't you not borrow from bank?
Bank is okay, but bank leverage, how much it will come? I'm not stressing because options are very low. See, the first bottleneck is proprietorship concern. And beyond relatives, you cannot go. So before exploring other options, you must think what all is permitted to you.
What I can add to what my two predecessor speakers have spoken is, initially, if you want to borrow from a bank, because you don't have a rating, so there will be some reluctance. Their reluctance has to be overcome by way of giving collateral security, which gives comfort to them, and then borrow. Slowly, based on your performance, then your collateral security can keep coming down. That's one thing. Having said this, my suggestion, or maybe my other speakers, convert into an NBFC if you want to do. It's not a very difficult thing. Our suggestion would be convert into an NBFC. Your growth will be undiminished. That is where you can grow. All these things are like a palliatives. They are not permanent reliefs. You can grow to a certain extent, but in the process, keep in mind, if you really want to grow and you want to be business for a long time, you have to convert into them. There's a policy of the government and the regulator, both of them. And the regulation is going to be tough, but still there is a lot of support. If you see, 10 years before and now, when has the government recognized NBFC industry as a priority industry? We were always treated as stepchildren. And when has the government given, the regulator given hundreds of crores of rupees to NBFCs to see that there is no liquidity crunch for them? Banks used to get those support. They have given it. They are giving support, and they are also trying to regulate. They say it is a public money that is being given to you. You have to be cautious. So there is a lot of stringent regulation that's going to come. We have to be prepared for that. Something is being overdone. There we will have to fight. But if the regulators don't agree, we'll have to put up with them. There is no alternative. This is how I feel.
Initially, you will find it difficult, but then you will get acclimatized to it. You will get used to this NBFC culture once you convert. That's okay. Yeah, definitely. I think you wanted to ask. Okay.
Well, good morning, everyone. I do have a point to Mr. Deepak. Being an advocate and, addressing matter relating to drafting, we generally see that the bankers have a predetermined agreement which generally could not be amended. And since we were speaking about the governance, how do you address these matters when you have a particular clause, to be amended in your favor? Are the financial institutions who are funding us extending their support to amend those clauses, or we are forced to take it up the way it is? Can you please throw some light on that?
So I guess, when you're borrowing, you will have these kind of challenges, and it depends on the relationship you have and you discuss with the lender. Depends, it's a bank, they have their own ways, NBFCs have their own ways, financial institutions have different ways. So we have to, and somewhere we'll have to give and take, Somewhere we'll have to give, somewhere they will have to take. So that's how it works. There is no, there's no proper way of putting it. And you will have to be rigid sometimes, that these are the things which I will not agree to. And if they are willing to lend, they will lend. So it is typically like when you're borrowing money, somebody charges 15%, somebody charges 14%. Now you decide I want to take only at 13%, then you will say no on 15 and 14, right? So I think similar to that is how it works. And you will have to keep understanding, keep requesting, and maybe have some parameters of other companies who are using and get some experience out of them and ask experienced people like you to help us. So I guess that's the only way out for this.
Maybe one last question, because already there are some hints that we'll have to, some body language movement saying we have to stop. But one last question and then we can stop. You are a youngster, you can ask. If you ask, you have to answer yourself, but ask.
Having heard them, debt and equity, no doubt it's a good mix. But without having experienced both, out of my theoretical experience, I feel today private equity is difficult to service than a debt. Private equity is difficult to serve than a debt. Debt comes at a cheaper rate. Private equities, because we are also investing in alternate investment funds who are equity funds. So we expect returns of 15 to 60% from a fund. So the equity manager has to manage, fund manager has to have more than that. So in my opinion, on a crude basis, any PE will not look at you less than 18%. If 18% we have to give him, what should we make to survive as a finance company? Well, in today's cutthroat margins, I think making 21% IRR is very difficult as we scale up. So having made 21%, then your expenses, then 18% to them, how do you balance between these two? Of course, growth is needed, but how do you balance? What's the fine balance so that you are more towards debt than equity? Of course, equity helps again you for tier 2 capital, all those things. Second question is, because they have got a limited time horizon, 5 to 6 years. At the end of 6th year, we have to give an exit. If we don't, we are not able to give the exit, again it becomes a problem. So how do you manage that?
Yeah. See, it is not that one is a substitute for the other. These two are complementary.
Some disturbance.
These two are complementary. So when you are giving them an exit, you will not give the money by way of exit. You create a valuation. As your book grows and as your quality of the book is maintained, and based on your performance, the valuation goes up. It is not that they want you to pay up. It is impossible to pay up. Your valuation has to be created. Either you go for an IPO or you go for another investor who comes in and comes at a higher valuation, seeing the value in you. This is not a substitute for debt. It is always advisable to borrow as much as possible prudently within the limitations that we discussed earlier. But again, there is a certain limitation to which you can contribute. If you want to grow, then you need capital. When we are not, if we can invest, it's the best option. When you are not able to invest, you have to go for PE funds. Everybody wants a return on that. It is a business nation. So we will have to provide valuation for them and give them an exit. That's the first. Your second question is there, Ivan?
Same. He knows the answer. He wanted it from you.
IPO. Once you get into an IPO, that riding is not there. You will not be riding a tiger. It may be some horse.
One good thing is there are enough success stories about how this riding of tiger has been successful in several cases. So we can leverage on those stories as well. But we have to conclude.
But one thing is appreciate is the PE fund brings with them experience,
Knowledge.
governance. They hold your hands. You get people who are your partners. We are benefited by them. They give you business. They give you references. They take you to the next level. क्योंकि वो साथ में बैठ जाते हैं आके. So they want to grow and they make you grow. Many times I have seen small companies learn more from PE funds than their own directors. So definitely it's good to get PEs. We are just discussing.
He is being very upfront about who's more knowledgeable, PE fellows or directors. Anyway, that's okay. I think we have to now conclude. It has been a very interesting, fact-oriented discussion about the issue about private equity, debt, and the whole range of products. There is no one-size-fits-all approach. Each one has to decide what works in his business, in his own hemisphere, in his own geography, wherever you are situated. But get the advantages of both. And if you need to grow, you have to look at this very closely and try to find out what is the right prescription for your particular business. So thank you, Mr. Prasad and Mr. Dugar. Give them a very big round of applause. And then
the right questions. Thank you very much, sir. I think our panelists have very frankly put forth their experiences in raising debt as well as equity. Thank you so much to both of you, sir. BJK sir, on one phone call, he has accepted to travel all the way here. Thank you, sir. And thank you, Deepak ji. I now call upon Mr. Joskuti Xavier, President, and Mr. Basil Baby, Secretary of Kerala Hire Purchase Association, to present a memento to our panelists.